This presentation covers Extract 2 of the OCR F585 stimulus for examination in 2016, Globalisation and Balance of Payments Imbalances. So the extract starts off talking about how, although globalisation has increased world trade overall, and we all know the reasons for that, lower trade barriers, greater financial flows, lack of exchange controls and so forth, and technology and communications change, it's increased imbalances in the world's balance of payments. So what does it mean by imbalances? It principally means that some countries have huge deficits or surpluses on their current account of the balance of payments, and that those are not disappearing with the movements of exchange rates. They're not being eroded by exchange rate changes. Let's just remind ourselves about the current account of the balance of payments. It comprises of the balance of trade in goods, the balance of trade in services, which together make up the balance of trade X minus M. And immediately you can see how that relates to aggregate demand, and therefore you can consider how it affects our other macroeconomic variables, because the balance of trade is a huge component of the aggregate demand equation C plus I plus G plus X minus M. In the current account is also primary income, which is net property income from abroad, and secondary income. Secondary income used to be known as current transfers, and the remittances mentioned in Extract 4 would come into this category, so it will be important later on. Generally, though, we think of the current account balance as pretty much the same as the balance of trade, because that's the biggest component of it. And your current account can be in surplus, likely to be in surplus if your balance of trade is in surplus, and if imports are greater than exports, then you have a deficit, a current account deficit. And these large surpluses or deficits that persist are known as imbalances that this extract is talking about. So, which country has a massive surplus on the balance of trade? Well, as you may have guessed from this cartoon, it's China. So why does China have such a large surplus on its current account? Well, there are various reasons. The main one is that it's grown extremely rapidly, particularly since 1978, when Deng Xiaoping became premier, and 1990 it really grew from then, when China joined the WTO. All that investment, all that extra capacity, and the economy has grown very fast. It's pushed out a lot of goods. These goods are very competitive because labour is very, very low cost. At least until recently, China's been able to stay before the Lewis turning point, relying on ever more cheap labour coming in from the countryside to the cities. And the other way of looking at why they export so much is there isn't enough demand at home to satisfy their products, their production, and the reason for that is because the state-owned enterprises and state-owned banks have pushed money into investment and exports much more than consumer goods, that the state planning generally is based on selling abroad and not providing goodies for their people, and there is a kind of culture of saving in China rather than spending, which we might want to explore a bit later. The other reason why you could argue that this surplus has continued is because the People's Bank of China has not allowed the exchange rate to rise to erode their surplus. Why? Because they like the exports, because the exports keep business going, and these big industries can continue to make money and expand. So arguably it's been the manipulation of the exchange rate by the People's Bank of China which has done that. This is really important in the bigger story of how that affects global financial flows, as I'll explain later in this presentation. You might also argue that in many ways there's been a race to the bottom, and China has outcompeted other countries like America for manufacturing by exploiting labour and having lax environmental laws. These are clearly normative rather than positive bits of economics. What about the other side of the equation, the US deficit? Well, bear in mind, of course, when we think of deficits in America, we might well think of the budget deficit, its fiscal deficit, as well as the current account deficit. On this topic, we're thinking of the fact that America's imports are greater than exports. So don't get confused between the twin deficits of the United States in your essays. Make sure you know which one you're talking about, whether you're talking about the trade deficit or whether you're talking about the budget deficit when you write your essays. It is true, in fact, that they're linked, as I'll explain later, but just make sure you know what we're talking about. Here we're talking about that current account deficit, which is its imports more than its exports. Why is that? Well, it's a massive consumer. And certainly until the credit crunch, the Americans were fueled by ever increasing credit, lending, optimism, lower interest rates, an era of very low interest rates, which has helped along America's desire for consumption. Bear in mind, of course, that interest rates have just gone up, so that's going to change that just a little bit. There are changes in comparative advantage, a sort of structural change in the world, such that these Asian tiger economies, of which China is one, have massively increased their productivity in manufacturing. But also you can look at weaknesses in the American economy: underinvestment, high labour costs, leading to a lack of productivity and a lack of development and infrastructure. Don't exaggerate this point. America is still a very productive economy and in many ways a much healthier producer of export goods than the United Kingdom or other European countries. You might also argue, and of course you have to think about currency where you think about this question of why America's deficit has persisted, that for some reason America's exchange rate hasn't gone down as much as you'd imagine given its current account deficit. Therefore, its current account deficit has not been eroded. One of the reasons that has happened is because people keep wanting to buy dollars anyway. That's because of something called exorbitant privilege. That is, that American people always want the US dollar as a reserve currency. The next slide is called the Yankee yin-yang. And what I want you to understand is that really there are two sides to this coin of global imbalances. For a start, there is the point that America's deficit is sort of matching China's surplus, that both countries seem to benefit in a way from their very sort of complementary relationship. China seems to want to produce and be an exporter and a surplus country. Americans seem to want to consume. But also there's a kind of internal two sides of the coin. Remember that the current account and the financial account must be, as an accounting identity, equal and opposite. So America's massive deficit on the current account is a massive surplus on its financial account. So to say that America spends a lot more on imports and exports is the same as saying America receives an enormous excess of inflows on its financial account. And similarly, China, with its massive surplus, has got a huge deficit on its financial account. And the connection between these two is absolutely key to understanding the extract here. So what ways does this Yankee yin-yang relationship work? Well, one way is what I call the China price. The Chinese, over the last 20 years, have been producing loads and loads and loads of cheap products, undercutting others, driving world prices down. And that means the consumer goods that the Americans and other big consuming countries have been buying have been ever lower prices. This disinflationary effect has allowed America to continue to consume, continue to boom, continue to buy imports without inflation building up, without their economy overheating. So the China price has put in disinflation in the world economy over the last 20 years, and that has had the effect of enabling really the kind of massive consumption of credit-fueled economies like the USA. and the UK. I said earlier that America has twin deficits. It spends far more than it gets in taxes as a government, as well as spending more on imports than it sells and exports as a nation. Now, these are connected because in order to finance its massive government deficit, the government has to keep issuing bonds. But the Chinese, amongst others in the global saving countries, particularly Asia and the petro-fueled economies, over the last 15 years have been buying lots and lots of American debt. The reason that China has wanted to buy American debt is because if it wants to push its exchange rate down, it needs to buy something denominated in something other than RMB. And the only thing that there's enough of for it to buy in the kind of volumes it needs to do to push down its exchange rate is the American T-bill, that is, American government debt. So it's two sides of the same coin. It's a Yankee yin-yang. It's a circle of manipulation. The Chinese have been buying America's debt, which has allowed it to run huge government deficits, which keeps the economy going and means that there hasn't been higher interest rates, higher inflation, or a contraction in aggregate demand. And that inflow also accounts for why there's a huge positive coming into the American financial account, which finances the negative on its current account. Complicated stuff, but it all connects, and this extract really is testing whether you can pause this video now and think and close your eyes and work out how this great macroeconomic circle of manipulation operates. One of the things that you should be able to note from the data presented to you in the extract, in the stimulus, which I show on this slide here, is that the US deficit is greater than the Chinese surplus. So it's not just about China. The Americans are spending more on imports than they sell in exports, and they're importing from all over the world to a large degree, not just from China. And one thing you must bear in mind is the balance of trade figures here show only the absolute value in money terms of the product that's sold. So when an iPhone assembled by Foxconn in China is sold to America, the full value of that iPhone is represented on the balance of trade. But actually that's not the added value, because the Chinese have had to import very many components of the iPhone. Some from America, which does cancel out on the balance of payments, but also a lot from South Korea, a lot from Germany, and so on. So in the iPhone example, what the figures really show is not a massive trade deficit with China, but a massive trade deficit with China and all the countries that provide the components to Chinese products. One of the things you might also look at here is the slowing of China's growth at the moment, which is very worrying for world trade altogether. And the fact that the Chinese surplus is shrinking over the period shown in your stimulus. The narrowing of China's deficit is not in fact borne out in more recent data. As you can see over the period since 2011, the light grey figures here show exports and the blue imports. You can see that the Chinese volume of exports is enormous, but also they import a tremendous amount. Now that's because they're a developing country and they need a lot of the fancy components and the fancy capital required to produce their manufactured goods. Recently, the amount that they've imported has fallen quite considerably while their exports continue to be strong. So in fact, the Chinese surplus on the balance of trade has increased. The effective exchange rate is a weighted average of a country's currency relative to other major countries, with weights determined by the proportionate importance of trade with each country. In the UK we call it the sterling ERI, which is a trade weighted exchange rate index. It's the exchange rate of your currency against all others, weighting all others according to how important they are. And these are the figures that we're given in the stimulus for the American ERI. and you're supposed to say that it's gone down over on average, and that it hasn't gone down an awful lot. The thing you must bear in mind, if you look at the data that you were presented in the stimulus, is that the most recent figures show it in fact going up really quite considerably. So we know with hindsight that the examiners don't know that the overall trend between 2007 and now is that in fact the US dollar is stronger. That recent rise is really quite significant, but largely because of the Fed rate rise, which should always push up exchange rates, as indeed it has. So, for revision purposes, and because the examiners clearly want you to remember this stuff, what determines exchange rates? Well, economic fundamentals determine exchange rates, which affect competitiveness and trade, exports and imports, but also the level of interest rates. Speculation is a really hugely important determinant of exchange rates in the short run, financial flows both in that sense and in the longer run, and government intervention. The fundamentals include the rate of inflation, how productive your economy is, and what the infrastructure and investment are like, how prudent your macroeconomic policy has been, particularly keeping inflation under wraps and stable, and what arrangements you have which allow money in and out, people to invest, FDI to come in, and businesses to do well, all of which determine your international competitiveness and therefore how much people want to buy your goods, which will determine the demand for your currency, or how much your people want to buy imports, which will determine your supply of currency. And also you have to remember that speculation and financial flows on the financial account will affect the exchange rate. Not only are these much, much bigger in volume, so in a way more important than the real things. So curiously, things which are unimportant are more significant on the determinant of exchange rates than things which are really important, like the productivity of your economy, just because the volumes of money that these traders, these forex traders, move around is billions and billions and billions of dollars in very short space of time. And one of the sort of medium to long term determinants of exchange rates has been this global savings glut. Poorer countries like China are having an enormous amount of money now, of savings that they use to buy American T-bills, which has kept the American currency from being weaker. So the Fed recently raising its rates has also pushed up the exchange rate. I've used the kwacha, that's the currency of Zambia, as an example in this graph, just because Zambia is our main country on the stimulus. So the supply of your currency, in this case, let's say we're Zambia, is the supply of kwacha, the green line here, and it's determined by your demand for foreign currency as a Zambian. So that's for your demand for, say, oil that comes from Nigeria, or American products, which are all measured in dollars. So it's really determined by our demand for imports, both imported goods, but also imported capital and imported financial assets. The demand for pounds is, should say kwacha there, of course, is determined by the demand for kwacha-denominated goods and assets by holders of other currencies, foreigners. So this is determined by the demand in money terms for our products. And if we're Zambians, we're making copper. 77% of our exports are copper. So when the copper price value in the market deteriorates, that leads to deteriorating terms of trade for us, less demand for our kwacha, our currency will go down. As China weakens, the Chinese economy grows more slowly, they demand less copper for their building. And this ties in nicely with the hint in the extract, in the stimulus, that it'll talk about why a depreciation in the exchange rate should affect your balance of payment situation. The stimulus says changes in the effective exchange rate of the United States, see figure 2.2, did not always have the expected impact on USA's current account deficit. The expected impact is that pricier imports should encourage consumers to switch towards domestic products, stimulating local production, and secondly, that your cheaper currency should boost growth by spurring your exports because they're now more competitive in the world market. So why isn't there been this same expected effect? Well, the textbook explanation is that maybe the Marshall-Lerner condition doesn't hold. The Marshall-Lerner condition is that the depreciation will only improve the balance of trade if the sum of the elasticities of imports and exports is greater than 1. Now, we think that actually X and M tend to be inelastic in the short run, but are probably sufficiently elastic in the long run for the Marshall-Lerner condition to hold. And that would give you a very nice J-curve effect over time. So there's a strong sense that the J-curve effect is a lovely bit of A-level theory that they want to test in this year's exam. Other obvious points about why there's been no real improvement in the American balance of trade despite a fall in their exchange rate is that the fall hasn't been sufficient. It's not very significant really, and the Chinese continue to manipulate their currency downwards, creating more competitiveness, although you can't really have them both ways. And I just put a little hint here to consider Dutch disease when you think about the Marshall-Lerner condition for Zambia. The reason is that it might be that Dutch disease reduces the elasticity of demand for exports and imports, because Dutch disease means that you find it very difficult to switch to different products and export them if you have a depreciation. So, back to the Yankee yin-yang. By the way, please bear in mind that I've made this term up. I hope you understand what I'm trying to say here, but you can't use that one in your essays because I just made it up. The other part of the picture of global imbalances, says the stimulus, is financial flows from developed to developing to developed economies, which is the wrong way around in theory. You'd think that the rich countries had the savings and they were flowing in investment to poor countries where the rate of return should be higher. That's what the textbook would say, but the real world, it's the other way around. The Chinese have excessive savings. That's pushing into the financial account of America because they're buying T-bills, which is financing the twin deficit in America. And you can see that this is being described in the stimulus as well, just proving that this circle of manipulation, this yin and yang of the relationship between China and America, is very much on the minds of the examiners for this year's paper. Why does China save so much? Well, there are various reasons. Instability in the past and political uncertainty and a lack of a proper welfare state means that Chinese people have a tendency to save so that they can provide for their children and provide for a rainy day. And it's possible that there aren't the investment opportunities in China anymore, so they're being pushed out into the United States, as well as people wanting to get their money out of the country. And finally, the Chinese government have been wanting to build up US dollar reserves at various times in order to manipulate their exchange rate downwards, which is the circle of manipulation point. By the way, as China creates increasing competition for countries like Japan have had to buy dollars to keep their exchange rate down, so that just adds to the inflow and the financial account for the United States, and therefore their ability to run enormous deficits without their currency depreciating and without them having tremendous problems. The global imbalances refer to this extract. And there's other reasons, in fact, why a depreciation might not be have the expected effect. And these are ideas I got from a recent Economist article on this topic, and so these slides may be familiar if you've seen my presentation on this. One thing that they say, in stark contrast to what you'd expect from the J-curve effect story, is that most of the effect of a depreciation happens within the first year. So if this data is correct, which comes from the IMF, so that's a genuinely respectable source, then the J-curve effect argument for why America's depreciation didn't improve its current account very much cannot be used, or at least you've got an evaluation point based on data against that. So that's worth pointing out. And it says here that a depreciation can boost net exports by 1.5% of GDP. So that's not bad, actually, but they haven't had the expected effect. And here's a case study of China, where their exchange rate index, just like the measurement that we have in the stimulus from America, has gone down between 2012 and 2015, but their exports haven't budged at all. And that this non-effect of a depreciation, not the expected effect, as it says in the stimulus, is similar in various countries. So why is this? Well, according to The Economist, one of the effects is the effect of peak trade. That's trade growth slowing now, and therefore these countries which are devaluing are getting a larger proportion of the world trade that's going around, but world trade is falling, or at least not rising very fast. Another explanation, which is rather an elegant argument, is that global supply chains are now so complicated, and everything is so production is so distributed across different countries, that you'll find that a depreciation will make your exports more competitive, but lots of your exports rely on imports of other things, components and parts of the process which come from other countries, and therefore although you get the advantage of your final good being cheaper on world markets, a lot of the intermediate components are more expensive, so you end up not gaining as much from a depreciation as you might initially think. So I've rattled through some really quite important areas of global macroeconomics. Try and think deeply about how you can use the balance of payments accounts to understand these global imbalances of the world's savers and borrowers, and why it's been in the interests of both sides to continue this circle of manipulation, the yin and yang of global imbalances as a result of globalisation. Thank you for listening.